Vacation homes come with certain tax rules that are different from a primary residence. In this video, we'll go over the essential vacation rental tax rules that you need to know to prepare your paperwork for tax day. Rental property versus second home. First things first, is your vacation home actually a vacation home? A vacation home can be viewed as either a rental property or a second home, but how it's classified to the IRS will change how you file taxes for that property. If your vacation home is an investment property, then these two things must be true. It is not your primary residence, and it was purchased for the purpose of generating income. Basically, if you buy a property with the intention of making money off of it rather than having your family live there, then that property is an investment property. A second home is an entirely different beast. It's defined as a residence which you and your family occupy for part of the year in addition to your primary residence. Usually it's used as a vacation home, though it could be a condo or an apartment in a city where you regularly conduct business. Tax for investment properties. If your property qualifies as a rental or investment property, it's taxed entirely differently from a primary residence or a second home. Because these properties are purchased and owned with the express intent of making an income, you need to report your rental income and expenses on a Schedule E form. You will then pay the taxes you owe after deducting your expenses. Tax for second homes. Second homes, on the other hand, get treated the same as a primary residence when tax day rolls around. This means that all the same rules apply to your mortgage, property taxes, and interest. Is it a residence? This brings about the question, how do you know if your home qualifies as a residence? What if you use it as a second residence but rent it out through services like Airbnb part of the time? Basically, if your home is rented for at least 15 days of the year and your days of personal use qualify your home as a residence, then the rules of a vacation home apply. The 14-day rule. In the simplest possible terms, if you rent out your property for less than 14 days of the calendar year, then you can pocket the income without the property being viewed as a rental property, which means you don't have to pay taxes on it. If you rent out your property for more than 14 days of the year, then the property is officially an investment property in the eyes of the IRS, and tragically, you have to pay taxes on the income. Personal use. The actual definition of personal use is fairly broad. It includes any days that you, your family, or a relative stayed in the property, even if that relative was paying rent. But it also includes days that you have donated use of the house, for use in a charity event, for example, or days that you rented it out for less than fair market value. Writing off rental expenses. Many rental expenses can be written off under Schedule E, which is great news if you own a rental property. Some common things you can write off include homeowners association dues, condo dues, insurance premiums, cleaning and maintenance, and more. However, it also includes less obvious deductions like fees required to pay an accountant for your Schedule E taxes. Want to know even more about taxes for your vacation home in Myrtle Beach? Contact us today. And if you enjoyed this video, be sure to like, comment, and subscribe.